5 key aspects of investment planning. Financial planning 101, a roadmap to achieve your financial goals, episode 8. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions so that you can reach your financial goals faster and smarter. 5 key aspects of investment planning. What are all those 5 key aspects when you make an investment you have to check? That is what we are going to see in this video. So far in our financial planning 101 series, what are all the things we have looked at? I'm going to list down a few things which we have looked at. How to bring cash flow under your control, how to create investable surplus, how to create a foolproof financial protection with the help of term insurance, health insurance, and other protection plans. How to choose the right insurance plan, term insurance, why is it important, and how to choose term insurance and what are the do's and don'ts, what kind of health insurance cover you should have, and how do you tackle your emergency requirements, all of us. All these things we have delivered in our previous sessions. If you have not seen those videos, I suggest you to pause this video, watch those videos, and again join here. That will give you a right kind of thought flow. In our episode 2, building your foolproof financial protection, we have completely seen life cover and other things. In our other episode 2, how to bring cash flow under your control, we have discussed something called investable surplus. From your budget, how do you figure it out? What is your investable surplus? We have dealt in detail. Also, we have given an investable surplus calculator. For your convenience, I am giving the downloadable investable surplus calculator link in the description of this video as well. You know, you have enough surplus to invest when you do this calculator. With that investable surplus, how are you going to implement your investments? What are all the things you have to check in your investments? You may have some existing investments. You may also want to do new investments. You can review your existing investments with these 5 key aspects, and you can revamp. Also, you can check before entering into any new investment proposal with these 5 aspects and validate whether to purchase this or not. This is as simple as that. First thing, what is the motive of your investment? What is going to be the motive of your investment? What is your financial goal? What is your investment objective? You have a financial roadmap. You want to move from here to there. There are different milestones. You want to buy a property. You want to repay your loan. You want to send your son for higher education, daughter for higher education, son's wedding, daughter's wedding, your retirement. From retirement to life expectancy, you want to have regular inflation adjusted income. These are all major milestones, different financial goals you have got. When you are selecting an investment and assign a specific investment goal attached to it, simply you can start an SIP without assigning an investment objective to it. But the moment you assign an objective like, I am accumulating this SIP for my daughter's education, I am doing this SIP for my daughter's wedding, then in both these cases, after assigning the financial goal, maybe after 2-3 years, if there is a requirement, right, you want to plan for an international vacation with your family, if you have not assigned a goal and you are simply doing an SIP, you may withdraw from this corpus and go for international vacation. However, if you have assigned a financial goal like daughter's education or daughter's wedding, you will really feel guilty to withdraw from that particular investment. That is the purpose of assigning a financial goal to all your investments. that gives you a lot of power in achieving your financial goals and putting you in the right track. So, activity item 1, list down all your investments in a spreadsheet. List down all the investments. Think of its purpose. What is the purpose you can assign to it? Is it for repaying your loan? Is it for purchasing property? Is it for kids' future? Or is it for your retirement? Right? That way, when you assign it, it becomes a firm investment in your portfolio. And also, if you have multiple goals, you are not sure where this has to be assigned, give priority. If you have kids' education and also vacation, give priority to kids' education. That way, prioritize based on the goals, you can prioritize it. Also, when you do this, you will obviously know which goal has got enough money, which goal has got lesser money, where there is a gap that needs to be achieved. It is an additional benefit when you do this exercise. Second aspect which you have to look in any investment is what is the yield, what is the return this particular investment is giving. Of course, this is something which I did not explain you, because subconsciously we are programmed now to look what is the return this investment can give me, right? I would say people are over focused on a return, how much return this is giving. However, there is one fine print what I would like to give you is list down all your investments. Calculate the post-tax return of your investment. Many a times we take, okay, FD is giving me 6%, PPF is giving me 7.1%. Both are not same. FD, like you have to pay tax, PPF is tax-free. So both are not same. So identify post-tax return. One more additional step you have to do when you are looking at return is what is the current rate of inflation? Whether this investment will help me beat inflation or not. There is a next step we have to do. Compare it with other similar investment products. I'm taking, many a times people end up taking an endowment money back plan which gives only 4.5% return or 5.5% return, because they don't understand what is the actual rate of return it is giving, and also is it helping them to beat inflation. These two questions, if they try to answer, 90% of the people will not buy endowment or money back policies straight away. So list down all your investments, check what are all the post-tax return you have got, and whether that particular post-tax return is enough to beat the inflation. If it is sufficient to beat the inflation, then fine, you can go ahead and continue those investments. If it is not possible to beat inflation with that investment, then still do you have to keep that in your portfolio? What is the purpose it is going to serve? That you have to answer. Based on that, you can keep it or remove it. So whenever you are making any new investments also, check this return part from any investment. Post-tax return, inflation beating return. Third aspect to check is threat. Threat is the risk factor. What kind of potential risk this particular investment has got? Risk potential of this particular investment. List down all your investments and understand the risk in your investment. Today, market has conditioned most of the investors to over focus on return, and we go unnoticed or go out of focus in the area of risk. So I would strongly suggest you to focus on risk first. What is the threat this particular investment has got? Once you understand risk, you will be better equipped to take a decision. At times people think investing in FD, investing in bonds, investing in post office monthly income scheme seems to be a very safe option, no risk. But investing in FD has got very low return, and because of that you will not be able to beat inflation. Not beating inflation is another risk. At times people invest in company deposits just to gain additional 2% return than bank deposits. But company deposits can default. 100% money can be lost. Credit risk is there. ILFS, DHFL, yes bank bonds couldn't repay single penny back to the investors. That way, just for 2% additional return, people risk 100% of their principal. So this is not a calculated risk. People have taken blind risk. Always understand what is the kind of risk your investment has got. Is it a risk-free investment? Is it a market risk-based investment? If it is a risk-based investment, understand what is the level of risk you have got, right? So based on the risk you are taking, do you have right appetite? Do you have enough time to provide that risk to manage itself and come back to normalcy, to manage that volatility? And also, do you have right strategy to manage that risk? Understand. So based on all these things, take a well calculated risk. Don't end up just taking blind risk. After taking an investment and realizing the risk involved in it is not worth investing. Before investing itself, you have to understand whatever the existing investments you have got, rate the risk potential you have got, reassess. Also, when you are investing fresh, check what is the risk involved in each and every product. Next important aspect to look in each and every investment is liquidity. Liquidity is the quick ability to encash that investment. How quickly I can encash it. If it is a stock market investment, most of these stocks are highly liquid stocks, so easy to liquidate. If it is a mutual fund, easy to liquidate. If it is a real estate investment, not so easy to liquidate. If it is an insurance policy, it is difficult to liquidate in the first 5 years. Similarly, like there are many products where the liquidity is compromised. So do you have to invest in such illiquid assets? Many a times people simply look at few factors, like whenever they are buying a second property, they don't need a second property. Just for investment purpose, they buy a second property. Just they will check, do I have enough money for down payment? Do I have enough budget to accommodate EMI? What kind of rental yield? What kind of builder? What kind of future prospects on the investments? And they straight away go and invest. Down the line, after 2-3 years, they'll regret money is getting locked in illiquid asset and kids are growing up, they need illiquid money, right? So because they are buying this property, illiquid asset, their retirement may get postponed by 4-5 years, which they may not realize when they are doing it. So that is why liquidity ratio plays a vital role in any investment. So list down all your investments, find out how quickly you can convert those investments into cash. Compare it with other products. There are similar products with better liquidity, better to convert them. Fifth and final aspect to look in each and every investment is what is the expense. To take that investment, is there any real expense involved? It can be ULIPs, it can be stock, it can be mutual funds, it can be anything, right? What kind of expense, what kind of cost it involves? There are two types of costs. One is how much additional fee money I am paying as charges, right? Other is non-monetary. It may be like you have to spend a lot of time to liquidate that, operate it, to monitor it, to execute it. So you put a cost for your time also. So it depends on that, you have to decide. In some of the financial products, costs are not very transparent, especially in ULIPs or in PMS, in alternative investment funds. Cost is not very transparent. Many a times it is hidden. We have to dig deep dive and understand what is the kind of cost they have. In ULIP, if you clearly look at it, there will be an allocation charge when we enter. If you want to discontinue in between, there will be charges. If you want to surrender, there will be charges. Whereas in mutual funds, there is no entry charges, there is no discontinuation charges. If you're withdrawing after 1 year, most probably there will not be any charges, right? Like this, you have to understand what is the cost involved in each and every product. Similarly, when you are investing in mutual funds, there will be an expense ratio. If you are investing directly, it may be lesser. When you are investing through regular, it may be slightly higher. However, when you are investing directly, you have to do all the work. You have to track it on your own. That way, you have to spend more time. It is also a cost involved. So understand all these costs. If you are buying mutual funds through your Demat account, there will be additional brokerage charges they will be charging. So all these additional costs you understand. Similarly, when you are buying and selling a property, there will be brokerage charges, there will be time involved in it. You have to take the potential buyer and show the property, like many a times, multiple times, and finally it will come to a conclusion. Again, paperwork, stamp duty, the heavy entry and exit cost is involved in it. So that way, pay key attention to the expenses, because expenses can reduce your overall return, both from your like monetary expenses wise as well as in time expenses wise. So list down all your investments and find out what are all the costs involved in it, and also compare with other similar products to find out what kind of charges they charge. And if you need a help, you can choose, you can get a help from your investment expert or financial planner. Now you have understood all the 5 key aspects, right? Motive or objective, then yield, return, then the third is threat or risk, and the fourth one is liquidity, and the fifth one is expenses. All these 5 aspects, now is the time to apply it. Take all your investments and apply all these 5 things and find out what is really worth keeping in your investments, what is worth to get rid of it. Many a times people keep a lot of unnecessary non-performing investments. They are unnecessary luggages in your portfolio. It can drag down from your financial progress. That way, I want you to apply this on your existing investments now. Also, whenever you are planning to buy any new investments, apply these 5 aspects. Understand these from anyone who is trying to promote those products. Hope you got a complete idea on the 5 aspects. If you have any questions on this investment planning or any other investment options, feel free to book a free appointment with our certified financial planner. To book the link for the free appointment, I have given this link below this video in the description. I have also given one more link below this video for webinar registration. We organize regular insightful investment webinars with eminent investment experts to educate the investor community. And this webinar is completely free for you. Just leave your name and email ID. We will book your seat and send the invite for the next webinar. You will be able to discover a lot of good investment strategies and wealth creating techniques. Hope you like this video. I'll again meet you in yet another useful video shortly. Bye bye.